G'day everyone, welcome to FinChats. My name is Hoi,
And my name is Hugh.
and today we're talking about factors in portfolio constructions. So, Hugh, what are factors in portfolio construction?
Yeah, sure, Hoy. Factors in investing or portfolio construction, they refer to these sort of premiums that have been known to give some sort of return over the long run. So, for those who have studied finance, you may have heard of the Farmer French model, three-way model, or the five-factor model. And essentially, it's saying that, over a long period of time, these factors have shown to persistently generate returns and across different regions. So, some of the common factors you may have heard of are value, growth, momentum, quality, and now also low volatility as well. So it's saying that, if you've allocated to any one of these factors over some period of time, you should expect some sort of risk above and beyond a normal benchmark because you're being compensated for that particular factor risk you're taking on. Factors have been around for decades. As I said, it's been founded by the Farmer French sort of team. And so it's become a very popular way of investing. The smart beta option has also risen in popularity, recently because it is really going just slightly above the benchmark and adding that sort of incremental risk premium. So if you are allocated to the benchmark, you get beta, which is some sort of market return. And smart beta is essentially just getting that additional risk, whether that's through value or growth, quality or momentum. So that's what factors are in investing.
So, is it fair to say if I can translate it into the layman's term, it's the style of investing, and obviously, you can go for growth, a growth style, maybe pursuing a more risk orientated approach, or maybe a more conservative approach to investing. So, a kind of an investment style that you would be pursuing.
Yeah, that's exactly right. It is really a style. A lot of investors out there, they may, classify themselves as value investors. Warren Buffett and Lynch are quite popular investors under the value camp. And then you also have growth investors, which are taking the opposite side, or not the opposite side of value, but their philosophy is quite different to value, where they don't put that much of an emphasis on valuation or price. They really look at earnings, 10, 20 years out, and they're willing to pay more for those growth companies. So, there are strategies out there that are targeting momentum, where you're riding share price revisions upwards, and also low minimum volatility strategies as well. So yes, to answer your question, it is just another way to express different styles of investing. Not everyone has the same views or philosophy or approach to the way they invest. Some believe in the idea of value, some believe in the idea of growth. Yeah, some people talk about the idea of quality, which we'll talk about in this video.
Because we're going to focus on one particular factor in portfolio construction, we won't have time to go through, all the factors. Let's focus on quality. So, what is quality? Quality factor when we're talking about portfolio construction. Why should we care about it?
The quality factor is really about companies that are able to generate consistent cash flows through time. They also generate high returns on equity, and they typically have lowly levered balance sheets. So that essentially means that on their balance sheet, they don't have too much debt. And so when you look at all of these different characteristics holistically, if you've got a lot of good cash flows that are consistent, you've got high returns on equity, then that should be able to service down the debt. And any surplus is obviously your reserves or your profits, which can be invested back into the company or used for other shareholder sort of reforms, giving back to shareholders. So, investors should consider the quality factor because it has, you know, been shown to perform quite well over time, as well as the other factors as well. But particularly in a market downturn, and you know, a lot of market participants are facing or pricing in some sort of economic slowdown in 2024, and so that's why the buzz around quality as a factor has started to rise more. You know, more people are talking about, you know, should we invest in the quality factor, because you've seen large whipsaws in the other styles in the last 3 years. Growth has done extremely well in 2020 and 2021, and then when rates when they started to rise in 2022, those growth companies were very hurt. So you know, they're typically characterized by your large big seven mega cap tech stocks. And on the flip side, value did quite well in 2022. And so we're facing a very, I guess, bleak outlook next year. And that's why people are considering adding that quality bent or tilt to their portfolios.
So when you say, people should consider quality or people should add quality to portfolio, it's for me, it sounds very simple, but many people out there might be saying, well, what should I be looking for? What are the indications of a portfolio? Is there any indication that I can see and point to and say, okay, this is what I should be looking for. This quality is better than that quality. What am I looking for?
Yeah, it's a really good question. There are a lot of products out there which are marketed as quality. I think that's a natural place to start. If you're a stock picker and you have a familiarity with picking stocks and valuing stocks, then it goes back to my point. You know, quality really revolves around profitability and those characteristics I initially talked about. So, yeah, you're doing calculations on what the return on equity looks like, not just now, but over the past 5, 10 years. You know, what has a history been for returning that sort of capital on the amount of equity they have, and then, you know, how much cash flows are they generating? Cash flows are different to net profit, which is just a reported number on the income statement. Cash flows actually make their way into and out of a company's bank account. So what does that look like? You know, again, is that sustained throughout time? And then also, what does their balance sheet look like? How much debt do they have? What type of debt do they have? And how much interest are they putting on that debt? And so, yeah, there's naturally a lot of work that's involved to identify what quality is. And so there are actually a lot of different products out there in the market, you know, ETFs, managed funds. So you could easily type into Google, you know, quality ETFs. And I think that, you know, the way to approach them is very similar. You know, they all have a very similar approach to portfolio construction. But again, you need to understand, you know, how do they look at quality? You know, some providers have different metrics and definitions of return on equity or debt to capital, etc. You need to look at fees as well. You know, fees are very important in the industry, because if you have even 5 basis points of savings, then that will translate into, you know, much higher returns over time. So, yeah, I guess to get exposure to quality, ETFs is a really good way. It's very simple to access on the market. But yes, with any investment, you have to do your research and see, you know, what the methodology is, what their fees are, etc.
Now, is there any difference to, when I should consider quality or any other factors depending on the economic cycle? You know, if it's a recession or going gangbusters, what is should I care about the short-term outlook when considering the quality factor or any factor in, portfolio construction?
You've seen factors perform differently in different market cycles. So if we talk about the quality factor, that has tended to perform quite well in market downturns, or when there is some, you know, adverse economic scenario, because what the market wants are companies that have the ability and the capability to be able to service their debt and withstand those tough times. So people would start to flock to quality during those market cycles. When I think about when growth has outperformed, that was during 2020, 2021. Rates were super, super low. There was a lot of monetary policy um, being pumped through into the system. So markets were willing to pay more for those growth companies. And then similarly, when interest rates started to rise, the market wanted companies that had more cash flows now rather than in the future. And so value tended to do quite, much better in that scenario. I think that, to your question, over the long term, though, over decades, all these different factors have generated some sort of additional return for investors above and beyond the market, but they will fluctuate throughout time. So what allocators have done, or more sophisticated investors, is that they will actually tilt their portfolio in and out of different factors. So let's say if you timed everything right, to make money, you would have allocated more to growth during 2020, 2021. And then when you start to see rates rise, you would have tilted to value. And now you might consider quality as well. So that, yes, factors do swing quite widely, but over the long run, they have generated that persistent return you expect for the risk you're taking.
Now, intuitively, when you say, add quality to your portfolio, the normal person would say, yeah, of course, why wouldn't I, right? But surely there's a trade-off between, I guess, the quality of your portfolio and the return. Is that a good assumption? If I load my portfolio with a lot of quality, um, what are the downsides? Am I, trading that with a lesser return? And what should people think about when they, allocate this?
Yeah, it's a good question. Like, you need to consider, obviously, when in a cycle, quality will tend to underperform or outperform. So, what I've seen and what the literature has seen is that quality has been a more consistent factor than value and growth over time. You need to also consider, okay, well, what are the risk-adjusted returns here? So what I mean by that is, yes, you can deliver, 10% returns, but maybe the risk that you're taking in growth is so much higher, and so that the risk-adjusted returns would be lower. So I think a key thing to look at is, what is the level of risk that you're taking in the portfolio, and that's shown through volatility. You can get these sort of numbers through like a website or whatnot. Just look at how that fluctuation has occurred through time. But yes, so value and growth, they tend to be a bit more whipsawy through time, and quality has shown a bit less volatility through time. But yeah, those are the sort of qualities you do need to look at.
Now, the last question is, we started off with the number of factors there, and you rolled off, growth, value, etc. A lot of people out there might be thinking, okay, well, just tell me which one's better, which one's the best, actually. Is there such a thing as the best factor? And, I only put my portfolio into one best factor, or should we consider, a range?
So, like, yeah, I'll just preface, like, this is not financial advice. Just take anything I say with a grain of salt. But there is no best factor. I think with anything, you can view factors like stocks. The more factors you have in your portfolio, then you have more diversification benefits. Value and quality tend to have good correlation benefits, because the qualities of companies in the quality bucket and in the value bucket are quite different. Value companies tend to have, the balance sheets aren't as good. They haven't generated too much profit, and that's why they're trading at lower costs. So maybe a value quality complement is a good idea. So yes, it really depends. I think that naturally, whichever factor you choose, if you stick to it over a very long period, all these factors have shown academically and statistically that have generated excess returns over time. So the key here is not to time the market, but rather to be in the market as long as possible. It's very hard to determine which factor will be in favor at certain times of the market cycle. Just have some sort of factor that you can stick to throughout time.
Very good advice. It's not timing the market, it's time in the market, as the old adage goes, right? So, thanks very much for the explanation on factors in portfolio construction, Hugh. That's all the time that we have for this video. So, if you like this video, make sure that you like, comment, and subscribe, and make sure that you also hit the bell icon so you can get notified for when the next video is out. For the time being, we'll see you in the next video.